Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions, capital raising, joint ventures, strategic alliances, real estate, affiliate and sponsorship deals, and more, including smaller deals that you can do without significant capital. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for over 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest Podcast. Let's get started. Stephen Speer is the founder and CEO of eCommerce Lending, a firm specializing in financing acquisitions, advisory, and search services in the online space. With a lending career spanning decades, Stephen and his team have utilized their expertise in assisting hundreds of entrepreneurs in achieving business acquisition success. As an e-commerce lender, guest speaker, and M&A instructor, he and his firm have funded over 500 transactions totaling over $1 billion, making them the top lender in the country in this very specialized niche. Stephen, welcome to the DealQuest Podcast.
Corey, thanks for having me.
So listen, I definitely want to get into all this conversation that your bio raises around financing and lending and acquisitions and the niche that you're in. But before we do that, I want to take you back to when you were a little kid growing up, maybe 10, 12 years old. What did you want to be? Because I'm guessing that a specialty niche lender and an M&A guy wasn't it back then, but you tell me.
I wanted to be third baseman for the LA Dodgers.
Okay.
I grew up in Southern California and I was in the Dodgers fan club and that's what I wanted to be. And then reality set in. I wasn't necessarily very good at baseball, although I have a strong passion for it to this very day. But I always enjoyed business and especially marketing and really, and I guess for lack of a better term, sales and helping other people.
Love it. Yeah, it's interesting how many of us had sports dreams at that young ages and quickly realized that wasn't going to be fruition. Good stuff. One other question looking back. What was your first deal of any type? It could have been something, when you were younger as a kid or could be early in your career. Anything that's a deal that you remember?
Interesting question. At a very young age, I always liked cars from a very young age. And I'm kind of a neat freak. So I always liked clean cars.
Okay.
So way back in the early 80s, I started my own car washing business and I would wash all the neighbors' cars. And that kind of evolved to detailing in the early days before anybody even knew what that was. So that helped have my pocketbook a little bit through high school, even in college, to detail people's cars. So that was, again, I come from a very entrepreneurial family. So I think that would be the first, deal.
Yeah.
Is to establish my own car detailing business.
Love it. It's so interesting how, many of my guests do have this sort of entrepreneurial background, but then many, including myself, my parents were not entrepreneurial at all. They worked for somebody for their entire lives. And I'm always interested in how we all come to that world and that interest. So it's interesting that you have that background. What kind of businesses was your family in, if you don't mind sharing?
My father he had his own CPA practice in Newport Beach. My mother, she was also an accountant. And my oldest sister became a tax accountant up in Marin County. Yeah. And my older sister is a employment attorney in San Francisco.
Oh, a lot of professionals in the family.
They all have their own practices. Although my father has passed away, we all have our own businesses and very much, again, back to the entrepreneurial fabric of my existence.
Love it. So let's talk about how you got, even before now being in the niche you're in, how did you even get into the lending and financing space originally?
Well, I started off like many of us in kind of brick and mortar financing. And I had a client approach me and say, listen, I'm not really looking for brick and mortar type acquisition opportunity. I'm kind of looking in the online space. And this was nearly a decade ago. And it was like, okay, and can you finance a business that sells its wares on Amazon and some of the other platforms. I'm like, I don't know. Let me see. I don't see why not. So that discussion with underwriting and other people involved kind of evolved to me being at that time the only lender in the space. And obviously we have evolved over time and done over $1 billion. So it was by accident. In short, it was by accident.
I love it. And listen, I mean, it's interesting to me in those early days, right? Because obviously doing brick and mortar businesses, the underwriting, the collateral, just the whole basis for a loan, the security for it, all that kind of stuff is totally different, right? And I guess there's when e-commerce was newer, it's like anything else. I mean, doesn't fit a lender's criteria, whether that's whatever aspect of their criteria, they tend to walk away from it. So what was that evolution like in terms of like, how did you, were you at a place then where they were, where it was finding like you're brokering capital from other places, or were they doing their own, lending directly? How did that transition happen? To be able
their own lending
deals?
And then I went out on my own, but very much they didn't know what Amazon FBA was. So I had to describe that Amazon isn't actually selling the goods.
Right.
There are Amazon resellers selling the goods. And I had to explain that. I had to explain where there wasn't like a warehouse in one location. It was Amazon fulfillment center. So I had to learn that. Once I learned that, I had to really train the underwriters how to look at businesses like that. And obviously now we all shop online.
Sure.
It's almost second nature. But back then, people had no idea. They actually thought Amazon was the one selling wares on over the internet. And It wasn't the case.
So how are these deals underwritten? Is it cash flow underwriting? Is there any kind of hard collateral of any type? But what's the underwriting criteria for deals in this space?
It's strictly asset light cash flow underwriting for the most part. Now on the SBA side, meaning the lower markets, we do quite a bit of SBA financing. There's not a collateral requirement, but they can take collateral, typically a home, like a second lien on a home or third lien on a home.
Yep.
So that's really what they're hanging their hat on. And they're hanging their hat on also the buyer injection. So the buyer has skin in the game, and that gives comfort. On the lower middle market side, so deals typically with enterprise values above the SBA arena, there are no collateral requirements at all. And it's strictly cash flow lending.
And they have enough. So what kind of cash flow, levels are companies looking like to get to that point where there's no collateral? Like what size businesses are eligible for that level of non-SBA financing?
Non-SBA financing, any business with an EBITDA or SDE of $2 million and above. And, we're betting that it's a strong business. We're betting on a very strong buyer. So it's not only about the horse, it's about the jockey.
Yep.
And also that person is required to cut a fairly significant check size for the acquisition. So, but we're comfortable with those types of loans and, we're successful at it.
That's great. And are you mainly focused on acquisition financing, or do you also finance just existing operating companies that need, whether it's working capital or other, for other purposes?
At Corey, we primarily focus on acquisition financing, but we also do some recapitalization or refinancing of existing debt. But our main bread and butter is acquisition financing. We just find that we'd rather be a master of one and not, whatever the saying is, know a little bit about a lot. We'd rather know a lot about very little. So that's what our focus is on. So
it makes sense. And listen, any kind of lending is a deal, but certainly on this podcast, we talk a lot about M&A, although I would stress that we don't only talk about M&A and capital raising. We talk about all kinds of deals, but certainly getting financed. So listen, I'm sure the question on everybody's mind now, and anybody that does financing of anything, is cost of capital and the increase in interest rates over the last couple of years. How has that affected your particular market in terms of the cost of capital around financing acquisitions?
That's a really good question. I think a lot of it's been counterbalanced by the drop in multiples.
Yep.
So that has absorbed a tremendous amount. Not all of it, candidly, but it has. I think the biggest challenge is our tightening credit market, especially with the lower middle market deals. Lenders are a lot more conservative than they were maybe 18 months ago or 2 years ago. So from that standpoint, deals are harder to get done, but we are getting deals done. But the cost of capital definitely has had an impact, but not catastrophic by any means.
Yeah, it's interesting because one of the things I always talk about, you see this in business deals, you see this in the real estate market, et cetera, is that in these times, whether it's cost of capital going up, other economic factors, things like that, there's always an adjustment period, right? Because it's often that sellers have yesterday's valuation in mind and buyers are very aware of today's valuations, including how they're impacted by cost of capital. And there's often just a period of time for those to re-meet. And in some sectors, it's slower. I mean, it sounds like in the e-commerce sector, it's not 100%. It has moved more quickly. In some other sectors, the sellers haven't quite moved as quickly to understand the new market.
Yeah, we are, even on the e-commerce side, we are seeing businesses that have been out there a while lower their prices, their price points. Or most recently, a business, I think their asking price was $8 million and change, and now it's down to $5 million and change. And there's a lot of buyer activity. But with that said, there are a lot of buyers in the marketplace. So it hasn't been a total decline because there are a lot of buyers looking for that acquisition to happen. So we've been fairly resilient.
So let's talk about who those buyers are, right? Are we talking about, are most of the deals being done by serial buyers who, let's say, are PE-backed or have capital? For example, we do a lot in financial services and especially in the investment advisor space. And that market has stayed super strong because there's so much PE capital and there are so many serial buyers. And sure, have deal terms adjusted, have multiples come down a little bit, but the market there was a first quarter of last year, it slowed and then it picked up again second quarter and the rest of the year was crazy. Or, are there more strategic buyers or are some of these at the lower level searchers or things like that? Who are the buyers?
So the lower middle market, there are more strategics involved there. And you're right. I mean, they're still very active. But again, we've seen prices drop on a lot of these businesses. Yep. And I think that has more of a reflection of what earnings came in at for 2023, especially if we're here in February. A lot of buyers are seeing a lot of sellers are seeing their year-over-year growth very much diminish due to the softening of the economy. So that's brought a little bit more, sellers seem to be a lot more realistic right now than they were, let's say, 18 months ago. Yeah. So in the lower market, so those buyers are more strategic, typically a group wanting to buy maybe a roll-up strategy of some sort. And then the lower markets, which is more SBA financing, those tend to be typically with us, they're not necessarily one and dones, meaning they're not just buying one business. Typically, they're buying multiple businesses over time. So we see a lot of, it's very active right now in that segment.
Right. And so obviously e-commerce is a huge, it's a sector, but it's such a broad sector, especially in the economy these days and how much business is done through e-commerce. Let's break that down a little bit. Are there particular sub areas within e-commerce that are more active, that are doing better, where there are more buyers around? To break that down a little bit into the types of business within e-commerce.
Right. So when at least we use the word e-commerce, it's kind of like Kleenex for tissues, but it also encompasses SaaS businesses, so service-based businesses, be it ed tech. So that's a real big one. Anything educational technology-wise is a really growing segment. So we see a lot of growth there, and the multiples are still sky high in that segment because also you have to factor in there's recurring revenue. So it does keep the multiples higher. So we haven't seen those price points drop very much. So there's that segment. And then the e-commerce where it's a tangible product where it's sold over Shopify and Amazon and also through a company's own website. Yep. So we're seeing a lot more softening in that segment than we are on the SaaS side.
That's it.
Software as a service side.
Yeah. Yeah. And then even within those, obviously, even though those categories break down a lot, are there any particular types of products or industries or SaaS businesses that you're seeing now that people are particularly looking at in the marketplace?
Yeah. Again, educational technologies is a very large segment. I think there is a little bit of a shadow cast over SaaS businesses right now, candidly, is AI. I think that could be a big threat to, I'll call it a more traditional SaaS business. We're starting to see a lot more concern about AI and how it'll affect these SaaS businesses. So we're just now starting to see that. And we've actually had a situation where we've had a buyer walk away from an opportunity because of that fear of what AI is all about. So that would be something that just has come into play most recently.
Yeah, it's interesting. Obviously, you mentioned AI. That's the hot topic in all the publications. They're always talking about it. People I know, I'm in a entrepreneurs organization lawyers group, and everybody's either trying to figure out how an AI may affect their particular legal practice, right? CPAs are certainly talking about it. Others are actually proactively helping to create AI solutions within their particular field. But it's such a relatively early, and AI is another word that who knows what it means, right? Like it covers so many things these days, and everybody speculates about the impact. And there's definitely a lot of investment capital, whether it's angel money, venture money, going into various things. But has there been? We haven't seen, and I'm not saying we're like the lawyers for AI, so we would know. We're not on the cutting edge of that in terms of deals, to be honest with you. But usually when you're relatively early on, more of the deals that are done in that sector are investment, right? Raising capital, that kind of stuff, as opposed to M&A. But have you seen anything going on M&A-wise in the AI space yet?
Not yet, but it's definitely going to be coming. So haven't seen it yet. I mean, those are mostly right now, it's kind of at its infancy. So it's mostly, looking for startup capital more than anything. Venture capitalists are involved with all that. So it really hasn't hit the business acquisition segment yet, but it will. I mean, it undoubtedly will.
Yeah, listen, no question. I mean, first of all, there's so many startups there. There'll be consolidation of some of those. And then also, I can certainly see existing companies buying up AI, successful startups in their particular niche, if they create solutions that will be helpful for some core operating business. So, yeah, no, it's definitely coming. Yeah, I haven't seen much on it yet either.
Corey, I think a little bit's the fear of the unknown. It's like when the internet came out. What does that mean? Like, how's it going to affect us? I think it's a little bit of that. Just the fear of the unknown. I mean, AI could be really great moving forward, or it could be a negative impact to society, and we'll find out here in the coming years. So I think it's that fear of the unknown.
Yep. So you also do some M&A advisory and buyer representation, right? In addition to providing financing in the space. Talk to us a little bit about that end of your business.
Yeah. So, on the advisory side, we have clients actively looking for opportunities, but they don't necessarily have the expertise of putting a deal together, be it the capitalization stack or the debt piece or whatever, and also negotiating. A lot of them are really good at running businesses, but they don't perhaps haven't crafted the ability to negotiate. So we get in there and help negotiate with them. We help with the deal structure, and it's been, honestly, it was kind of we weren't really set on doing that, but it's worked out really well for not only our clients, but ourselves.
And do you do that only on deals you're also involved in the financing, or is that a separate line of business totally, even if you're not providing any finance?
It's a separate line of business, but ultimately they're signing up for both engagements. So yeah, we're helping them negotiate, then we're helping them on a finance side, but it's siloed. They're separate. We don't force them to get financing with us by any means. So we do provide quite a bit of advisory. And again, I mean, it's just, we've done hundreds and hundreds of deals. So, and on the advisory front, I need to say that it's specifically for lower middle market deals. It's not for lower market deals. Yep. But been successful at it. We know a lot of the players. So I think we have a keen sense of how to negotiate deals.
That's great. Let's take a break from the show for a minute so I can tell you about an incredible resource my team and I have put together for you. Secrets of Deal-Driven Growth, Creative Ways to Grow Your Business, Even in Challenging Times, is a powerful ebook that helps you take DealQuest podcast episodes and apply them to your own life and business. This is the ideal tool for anyone looking for creative ways to grow as deal makers, and you can get yours now. It's as easy as heading to coreycupford.com/workbook and downloading your copy. While you're there, you can also consider joining our dynamic deal-driven community of founders, experts, small business owners, and entrepreneurs. Now back to the show. So listen, I'm sure there are differences amongst deals and even in subcategories, whatever, but generally in structuring these deals for e-commerce companies, I mean, we already talked about the fact that on the lending side, the financing side, it's really cash flow is not a lot of hard assets. So obviously that comes into structure on M&A deals as well, because it's not like a seller's going to get security, or there's no hard asset security, at least, that you get to back up any kind of deferred payments on notes or whatever. So talk to us a little bit about generally what these deals look like, how much is paid up front over time, and their earnouts, or there are any kind of retention clawbacks or things, requirements like that. Talk just a little bit. And I know, again, it varies, but.
Yeah. So I'm going to kind of backtrack a little bit on the advisory front. One thing on the advisory front is we're able to when we do look at a deal, we're able to advise not only how to structure the offer, but to make sure the offer mirrors the available financing for that given business.
Got it.
So that's a piece where we try to avoid our clients doing is going out on our own, putting in an offer, getting it accepted. They're coming to us for financing, and then there's no cohesiveness.
Right.
They're not on the same level. So that's one good thing about having us do both pieces, is that we're able to put those pieces together and not have to retrade on a deal.
Yeah, that's me.
So I just wanted to mention that. And what was your question? I'm sorry.
Yeah, no, it's fine. It was just in general what a deal structure is looking like in terms of from money back over back end, earnouts, that kind of stuff.
It depends on the deal. It depends on the conversations we have with the seller and or the seller's broker. If we look at EBITDA, obviously, and we look at what could happen with this business, the opportunities within the business, and that kind of all the answers to those questions helps us help our client craft the right offer. If the seller's like, well, we're at 2 million but I'm certain that we're going to be at 4 next year or 4 at the end of this year, whatever, then we're definitely including a sizable earnout component to that. So that's one thing. And then, so that's earnouts, one component. Seller equity role is another component, especially on the larger deals. It's very much part and parcel with those deals.
Yeah.
Seller note, that's also part of that. So it might be where it's a $20 million all in, where we're offering, 16 at close, cash at close, plus an earnout component, plus maybe a seller note or a seller roll. So that's kind of the cap stack of those types of deals. And then on the lower market deals, those are SBA deals. We help a little bit in terms of helping our clients put together a letter of intent, but we don't negotiate or anything. We're not really involved in helping our clients in that respect.
Yeah. No, that makes sense. In terms of those.
The cap stack's just a lot cleaner on SBA deals. You can't have, there are earnouts. Typically there are seller notes, and rarely are there seller rolls now that they're most recently allowed. So this is a lot cleaner, whereas the lower middle market type segment, there's a lot more complexities involved.
Sure. Now, most of the sellers, and again, this could vary as well, but in some industries, the theory at least is with e-commerce businesses, there's this theory that, they're easily, much more easy to be less dependent upon any particular individual, founder, et cetera, right? Unlike professional services, for example, lawyers, accountants we were talking about, or financial advisors or whatever, where it's, you're not, the old classic extreme joke, you're not selling widgets, right? It's very hard to do a deal where you exit right away, right? In fact, some deals are done where you're staying on for a long time, and it's just a way to roll into a bigger place, get more capacity, take some chips off the table. Even in the retirement or transition, succession deals, people are staying on often a year or two, or at least 6 months in a consulting if they have a strong management team underneath them. But at least in theory, the word is, oh, no, you can sell an e-commerce company because nobody knows who you are and it's less dependent upon you. How true is that?
It's not necessarily true, because that person, and often is the case that they've been running the business for a very long time.
Yep.
And they must have this, and on a lot of cases, they have the secret sauce to running that business. So if the business is heavily reliant on the persona, especially of a given seller, we definitely recommend having that seller equity role and keeping that person on and still being the face of the company, especially lower middle market deals. I could think of a few that we're working on right now where there is a seller equity role, and that seller is the face of the company. And on e-commerce, where it's product based, there's less of that. Yeah. But definitely on more, I'm thinking of one business in particular where I don't want to give out too much information, but where the business is very much the persona of the seller. Yeah. We insisted on the seller note on a seller equity role, because we knew we'd run into resistance on the underwriting side without that person staying on and continuing to be the face of that business.
Yeah. Yeah. Where did these deals go wrong? You have any, obviously without any names or whatever, but any horror stories? And no matter how many successful deals any of us in the business have done, there's always, none of us are 100%. Where did they go wrong? And do you have a particular story or two that would be illustrative?
I think it starts off sometimes, not always. I think buyers have not necessarily a keen sense of what it's really like buying a business.
Yeah.
And they do get deal fatigue. So I think that's one thing. It does take a while, especially in the larger deals, to close. It's not where you're buying a house and you close in 60 days. Generally, deals take a lot longer than that. So I think a deal fatigue and the buyer's ability to hang in there, as well as the sellers, I think that's where deals go wrong. The seller, becomes impatient on the buyer's ability to close. So I think that's one of the main areas. And then buyer's expectation. They start looking under the hood and realize the business isn't perfect. And I thought the business was 10 out of 10. Now it's like a 7 out of 10. I want to retrade my offer. And oftentimes those deals fall apart. I'd say those two things. One thing that doesn't happen to us, because we do a lot of heavy vetting up front on both the buyer and the business, is that deals fall apart because we're unable to shore up financing for our clients. The last 2 years running, we got 100% of our deals approved. But unfortunately, my industry has a bad reputation of starting the process and not getting the client across the finish line. So I think we've done a very good job at doing that.
And that certainly relates back to what you said earlier. While you don't require people to work on both sides, obviously, especially when you're providing the M&A advisory, when part of that advisory is based upon what you can get financed and the underwriting criteria, that it really reduces the risk of that disconnect, which we've certainly had that with deals where the client says, got the financing in place. And we obviously, as lawyers, try to coordinate with the banks to know what they want. But depending upon how much the client wants us involved in that or whatever, sometimes you find that there are disconnects. And they thought, client says, the bank will be fine with that, right? Then next thing you know, they've got a problem with whatever it is, in terms of structure, in terms of their own due diligence or things like that. So, I really get the value of the model you have.
Yeah, I think another key to our success is that we really our clients come to us before they start their search.
Yeah.
I think that's a huge component because we could literally lay out the roadmap to acquisition success. And unfortunately, let's say 80 to 90% of the buyers out there don't do that. They don't have their team in place. They haven't been pre-qualified. The businesses that they are looking at wouldn't qualify for financing in 100 years. And they're really they don't have a clear pathway to crossing the finish line. And we've been fortunate enough to really tweak our business model to the fact that vast majority, 99% of our clients come to us off before even starting that journey.
Yeah, so let's talk about that. So somebody comes to you, and let's say, what are the things that have them not be financeable at that time? And then I'm sure you give them some advice on how to get there if they're not there yet. So what are the things that come up in that industry in regard to being finance ready?
Yeah, depending on the segment, either lower or lower middle market. In the lower market, just lack of personal liquidity.
Yeah.
We have clients come to us. Most recently, a client wanted to buy a $5 million business, and he literally had no personal liquidity. He was going to raise his entire buyer equity piece or injection. And it's just, I don't know what seminars the guy went to, but that's just not going to happen. So no disrespect to that individual, but that would be one. Lack of pretty darn either strong indirect or definitely direct business acumen on the given business that he or she's trying to buy. That's the other piece. That definitely comes into play. And oftentimes people come to us initially and think it's like buying a house. Well, no, the lender's going to look at the buyer as much as the business and bet on the jockey as much as the horse. So we try to instill that in them that if you don't have that really strong skill set, you're not going to be approved. So we help guide the client that way.
Love it. And how does somebody show that? It's based upon past history. Do they need to be entrepreneurs before? If they were executives at companies with a good track record, what are in terms of that?
So we have them complete a questionnaire, very short, but a questionnaire. And then we have a subsequent phone call with them and really dive deep. And we want to make sure if they're looking for a SaaS business that they have some sort of experience. And we do look at, depending on the price point, especially the higher price points, we look for direct experience, not, hey, I was one person in a department of 1,800 that did this little thing. We're looking for someone with experience, not only direct experience, but also some sort of experience running a business. So we do look for that.
So we use terms, lower middle market, things like that, just so the audience, and I mean, those different people have different ranges that they put those terms into, just so the audience understands. Talk to us about the sectors you work with and how you define them in terms of, whether it's EBITDA, revenue, whatever you look at.
Yeah, I mean, lower market would be typically businesses with less than $2 million in EBITDA or SDE. So maybe a business that's running at, let's say, sub $8 million enterprise value acquisition and below, that would be lower market. Anything above that would be lower middle market, up to about, depending on the definition, we look at it lower middle market up to about 50 million is probably lower middle market, but depending on the day.
Exactly. All right. Anything else going on generally in your space that I haven't specifically asked about that, that's interesting right now or challenging, or where you see opportunities coming up this year? Or I know we don't have a crystal ball, but just,
Yeah, we don't have a crystal ball. There is a lot of uncertainty, especially election wise. So that's held a few people back, but for the most part, I think it's going to be better than 2023. 2023 is more of a transitional year from a really hot market to something a little bit more normal, let's call it. And I think this year is going to continue that to, more normalcy. We're not going to see, crazy multiples. I think we're going to continue to see multiples come down at least a little bit. And hopefully, I think by year's end, perhaps a lower cost of capital. I think that's, I won't say for certain, but I'm feeling that there's definitely going to be a lower cost of capital. And we're already starting to see a little bit of loosening of the credit market. So we're already starting to see that happen, which is great news.
It's great. Yeah, it's interesting. So, no matter how much we think we can read the tea leaves, it's, any of us who've been doing this long enough know that we can't. There could be a black swan event tomorrow before we even know it. Having said that, you sort of got to try to anticipate, and whether it's us entrepreneurs deciding how we're going to staff up or not, buyers making that decision to buy or lenders making that decision to lend. And, there were a number of factors pushing towards interest rates looking like they go down. Recently, there was a report where inflation was a little higher. So now that counteracts it. So yeah, it's an interesting time to see what will happen over this next year.
And I think if anybody's making an acquisition decision based on rates, they shouldn't be acquiring a business. That's just my own personal feeling. I think overall, you got to look at, can I make something of this? Can I scale this business that I'm acquiring? And if the answer is no, just walk away. So I think that's one play. Another thing that a lot of people, there are a lot of different variables that we can't control. So we either crawl in our hole and, or we make things happen. So I think that's part of the entrepreneurial spirit, that we control what we can control. And there are elements outside of our control that we have to evaluate and make a decision from that point.
Yeah, it's interesting because there are certain assumptions out there, and I think about maybe 18 months, 2 years ago, I did a solo cast on this, less around cost of capital at that point, but around inflation, which obviously at that point was way high and had gone up significantly, and before it started dropping again. And there was assumption even written in various of the trade and press or general, financial and business press about slowing economy and the impact on deals to some extent. And I've been doing this for 38 years, so I've seen a lot of cycles, right? And including some of the toughest times. And, I had a sense on something, and I did some research. And what I found out was that there is no correlation between deal volume and inflation rates, meaning that people would think, inflation rates are high, that's going to slow the economy, slow deal volume down. Well, no, that's not necessarily true. And there's less of a correlation with interest rates on deal volumes as well than people would think. And it's, in my mind, it's because, well, first of all, some of the best deals are done in tougher economies. That's where opportunities often show up, right? And, if you study some of the most successful deals are doing that. And also, while we talked about earlier with interest rates, same thing with inflation, like initially when there's some big economic event or change or whatever, yeah, usually there's a pullback, a slowing down. People want to see how it's going to play out or whatever. But then there's always a normalization that happens, maybe a new normal, right? And a lot of the deal banks, especially anybody who's capitalized, certainly can take huge advantage of situations. So I just, it's interesting because some of the assumptions that people make without looking at the research or without having decades of experience assume that some of these factors adversely affect the deal market and other parts of the economy. And it's not necessarily true.
That's some excellent points there, Corey. Absolutely.
So, all right. Well, so listen, it'll be interesting to see what happens in 2024 here as the year goes on. We've been very, very busy in various sectors. The biggest two we have are finance and the financial markets, especially like advanced investment advisors, people like that. And then also we do a lot in tech as well. And you're right. I think there's been more of an adjustment in multiples and things like in tech, but deals are continuing to go on. So it's not a bad thing. What other lessons along the way have you learned? Or is there anything else that comes to mind? I mean, any good stories either on the interesting deal positive side or on the deals gone wrong side?
I think mostly it's, for your viewers and listeners out there, I think the key is to have patience when you're searching. Again, it's not like buying a house. It takes months and months and months to find that right opportunity. We consult our clients in that very same way. Like, it's going to take time, and just be patient. You'll find that incredible opportunity, and just be ready to run with it, because they're behind you looking at that same opportunity. So I would say that would be my little bit of advice.
I love that. And I guess that leads me to my last few questions. Talk to me about, I often talk about mindset on this podcast, and like any of us who do this kind of stuff as a joke, whether it's with the investment bankers or lawyers or accountants, and I'm sure with you guys, and sometimes we feel like we're psychologists or psychiatrists, right? Sometimes because we deal with people, right? And you just mentioned it. I mean, even the ability, some people are better at having patience than others. Some people get over anxious, just their personality, or it's because of the lack of experience. Talk to me a little bit about that mindset and the psychology that I'm guessing you deal with as well.
Absolutely. I mean, every one of our clients is different. It's just really getting to know them very well, especially prior to formal engagement. And sometimes there is a match and we move our separate ways, but I could tell you that we have a good handle on how our clients think and what they're looking for, and what things, what the best approach with them is in finding that opportunity for them, or shoring up the financing for them. And so it's just getting to know the client. It's not a numbers game with us. It's a deep relationship that we have with our clients. They're not just a number. So I think that's the key. And then based on that, and we have some clients that are very impatient, I will say, but it's just knowing that, and it's just knowing how to manage that is the key.
Yeah, no, trust me, I agree. Yes.
We got everything done yesterday.
Yeah.
And it's, and setting proper expectations. I think that's a huge thing, especially in the ever-changing market of what we just experienced the last 18 months, is really, really honing in on really setting expectations. Like, Corey, it might take a year to find that right opportunity for you.
Right.
Yeah, whatever the case may be. So I think it's setting that proper expectation, and it's not just something that's going to happen overnight. So,
yeah, no, setting expectations is huge. Yeah, it's so interesting. And for me, frankly, it's part of the reason I find it interesting in what we do, because everybody's different, but every deal's different, but every person's different. And there are some folks, one of the things we say as lawyers is that there's a spectrum, but you have clients, one extreme of client is the client that we just did a deal, and it was great, because I love clients who are really involved, but who are like reading every period, every sentence. They have a million questions. They really want to understand it, and we're great with that. And then you have on the other extreme, what we joke is the where do I sign clients, right? Like they're not, you got to get them to focus. No, you need to read the reps and warranties, because we need to do schedules. And if there's anything that has to be disclosed, you got a problem, and they're basically like, where do I sign? So, and everyone.
You're so right. Oh my gosh, you hit the nail on the head. Right when you said those two examples, I thought of two of our clients that are polar opposites. One's like, where do I sign? The other one's like, okay, why are there two periods behind this last word instead of one? Did they, it's like, oh my gosh. Yeah.
Yeah. And listen, knowing how to deal with that, right? And without, any judgment of either, it's just how they operate, and protecting, them on both sides from themselves. The folks that overanalyze can kill a deal. You talked earlier about deal fatigue. And sometimes, I always talk about how there's a rhythm and a pace to a deal. And one of the arts of deal makers is that they understand that. And if you slow a deal, natural pace of a deal too much, that's often when the other party gets nervous and backs out or looks for a little. On the flip side, if you push it forward too aggressively, that could be a problem as well. So understanding that, and then combining it with dealing with the personality of your your client is really an art that folks like us, I'm sure you.
Yeah, it's that balance. If a client sees progression, even though it might be slow, that they're generally fine with that. It's when there isn't progression. I think our biggest challenge on our end is quality of earnings reports. I think those have the ability of killing deals, waiting around for those, especially on larger deals where it can take months to get a quality of earnings report. But time does kill all deals. I heard that saying years ago in business school. It really does. But you need that balance where you're showing progression, but you're not rushing things.
Love it. Well, listen, Stephen, there's so much more we could talk about, but we're coming to the end of our time. So before I ask you my final question, please let people know where they can find out more about you and the company and everything you have to offer.
Feel free to reach out, Stephen at eCommerceLending.com. That's Stephen with the PH at eCommerceLending.com. Or you could go through our website at eCommerceLending.com for additional information. Thanks for having me, Corey. Appreciate it.
Perfect. Great to have you on. My final question is always around my highest value in life, which is freedom. And for me, that means everything from freedom around the world for all people, from oppression to why I've been an entrepreneur for decades and haven't had a boss. What does freedom mean to you, and how does it impact your life and business?
I think definitely. I think having the ability to do what I like to do, and also I have the freedom to provide for my family without government interference is great. Hopefully it continues in this country. Not quite sure, but I think that's important. And all our God-given freedoms as listed on our amendments here in the United States are very important, especially our First Amendment. That's the most important, I think. So that's why it's first. Anyway, so that's what it means to me.
Love that. Stephen, thank you for being such a great guest on the DealQuest podcast.
Thanks for having me.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. The Deal Den is a place where entrepreneurs, high-level executives, and business leaders come together, support each other's growth and success, and share what's working best, as well as what challenges we are facing right now. You will get input not only from me, but from all of our members. We collaborate and serve each other. To join us, go to CoreyKupfer.com/DealDen. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.